Hello learners, welcome to our session today. I am your instructor, CPA Ringo Frederick, and in our today's class is a continuation of what we started earlier on. Recall, in our last class we had introduced the types of taxes, where we mentioned that we'll be talking of two main types of taxes, that is the current tax and deferred tax. So in our last class we had looked at the current tax. So in our session today I want us to focus on deferred tax to understand each and every concept behind deferred tax, So anytime we are to talk of deferred tax, what must we always tend to have in mind? Always you should be recalling the concept to do with the future implication of tax. This is what basically we normally term it as deferred tax. Just a moment here. So talk of deferred tax. Deferred tax. Talk about deferred tax. That is our main concept of today. And that's why Mwalimu is saying that anytime you are to talk of deferred tax, my good student, you just have in mind that these are taxes. These are deferred tax are future tax consequences to an entity. This is a form of future tax consequences to an entity, meaning that these are future tax and the consequences of these taxes in future. So that's why we are saying that deferred taxes are future tax consequences to an entity. These are future tax consequences to an entity. And according to International Accounting Standards number 12, you will find that requires an entity to provide for deferred taxes at the end of each financial year. That is, of course, according to IAS number 12. It requires an entity to always provide the deferred tax account as at the end of each year. So we are talking of International Accounting Standards number 12 requires us to provide for deferred tax. So the big question will be, we've looked at deferred tax as a future tax consequences to an entity. Now, how will we compute this deferred tax? To compute this deferred tax, basically we normally tend to talk of two main methods, which will include the following. We normally tend to talk of methods of determining deferred tax. Number one method, we normally tend to talk about income statement liability method. So talk about income statement liability method, though not commonly used. And number two, we normally tend to talk about balance sheet liability method. Balance sheet liability method. So basically, these are the two main methods that we normally tend to use while we want to determine our deferred tax. The determination of our deferred tax, basically, our main area, or rather methods that we normally tend to focus on, these are the two main areas, or rather methods: income statement liability method and balance sheet liability method. So to do that, I want us to dissect the first method and see what it entails, and therefore we are going to dissect our income tax liability method. Income tax liability method. I want us to dissect the income tax liability method and see what it entails. So my good students, anytime you have to talk of income tax liability method, you'll find that again this is further classified into three. Where these three classification will be talking of aspect to do with nil provision. Talk of number one, nil provision nil provision, nil provision, nil provision. Number 2, we'll be talking of the aspect to do with full provision. And number 3, we'll be talking of the aspect to do with partial provision, partial provision, partial provision. So these are the 3 main methods that we normally tend to consider anytime we are handling the concept of income statement liability method, income statement liability method, income statement liability method, income statement liability method. So these are the 3 main. So we are talking of this is income statement liability method. Income statement, no tax, correct that, income statement liability method. So we are talking of nil provision, full provision, and partial provision, the methods that we normally tend to consider. So by doing that, let us explain what nil provision is, what full provision is, and what partial provision is. So the concept is we want to look at the future tax consequences of an entity. And by doing that today, it means that we are purely estimating. We are purely creating provision for the same. So nil provision, basically, we are saying that for nil provision, you'll find that under this approach, no provision is made to deferred tax. No provision is made for deferred tax. Under this method, no provision is made for deferred tax. No provision is made for deferred tax. That is to say, provision is only made for current tax. Remember, we had talked of the current tax earlier on, right? So you're saying for nil provision, you are not making any provision for deferred tax, but the provision that you are making, we are making for what? For the current tax, for the current tax. That is nil provision. What about full provision, my good students? Anytime you have to talk of full provision, you'll find that at this point, we are making provision for both deferred tax and what? And the current tax. And this is the most recommended method according to International Accounting Standards number 12 that you should always be adopting, using full provision method, where we are saying at this point, we are providing provision for both deferred and current tax, for both deferred and current tax. That is a full provision. Then talk about the partial provision. You'll find that on our partial provision, we will provide provision for deferred tax only and not current tax. We're going to provide provision for deferred tax only and not the current tax. So these are the 3 types of provision that you must always tend to have at the back of your mind anytime you have to talk of what? The aspect of income statement liability method. That is nil provision, where in this case you are saying we are only providing provision for current tax. Full provision, we are saying that we are providing provision for both deferred and current tax, whereas for partial provision, we are saying that we are providing provision for only deferred tax, Now, the moment you're able to understand that concept and the definition of the same, that should take us to our second method, which is a commonly referred, or rather which is a commonly used. This time we are talking about the balance sheet liability method. Balance sheet, liability method, balance sheet liability method. Balance sheet liability method is our number 2 method that I want us to dissect. Balance sheet liability method is number 2 method that I wish us to dissect. So, my good students, anytime we are talking about aspect to do with balance sheet liability method, what must we always tend to grasp and understand? Mainly, this method views deferred tax to arise from the temporary difference. At this point, you'll find that we are going to view this method whereby it views deferred tax arising from what? From the temporary differences. It's going to view the deferred tax to arise from the temporary differences. And the beauty part of it is that Mwalimu had already talked about the temporary differences when we were looking at the main two, the temporary differences and what? And the permanent differences. So we are saying that using this method, we are going to view this deferred tax to arise from the temporary differences. And it is the method recommended by International Accounting Standard number 12 for computing deferred tax. For computing deferred tax. So one of the main elements, we are saying that, even before we go there, for us to determine this deferred tax, therefore, for us to determine the deferred tax, this is what you are going to consider. We are going to take our deferred tax to be the aspect of the temporary differences times the tax rate. Because we are saying that this deferred tax will arise from what? From the temporary differences. So we are saying that deferred tax will be taken as our temporary difference, we multiply by our tax rate. That is using the balance sheet liability method. And this is where you'll find that our deferred tax will arise by taking our temporary differences, we multiply by our tax rate. And the good thing here, Mwalimu had talked about the temporary differences earlier on. Remember when we introduced, we say that for us to determine our temporary differences, our focus will be on the difference between the aspect of the carrying amount we less our tax base. This is what will give us our temporary difference. Taking our carrying amount, we less our tax base. That should give us our temporary difference. Now, another key element to consider will be anytime you are to talk of the carrying amount, basically, my good students, what should click at the back of our mind? Talking of the carrying amount. Basically, we are looking at the difference between, this is basically for carrying amount. Let me squeeze it here, kidogo. So, carrying amount, if we were to talk of our carrying amount, basically, we are looking at the difference between it is the same as net book value, where we are talking of the difference between our cost minus our accumulated depreciation. This is what will give us what is known as the carrying amount. That is a cost minus accumulated depreciation. What about the tax base that you are saying here? Tax base, you'll find that also known as the written down value, WDV. Tax base, we are going to determine our tax base by taking our cost minus capital allowances. That will give us what is known as aspect of the tax base. That will give us what is known as the aspect of tax base. And therefore, for us to determine these temporary differences, basically remember we talked of two types. That is, of course, temporary difference and permanent difference. And we mentioned that at this point, temporary difference basically will occur when one item is considered in determining one accounting profit and ignored in the other form, ignored in the other area. So that's why we are saying that for us to determine this temporary difference we are talking of, the difference between the carrying amount and the tax base. And we've clearly stated that for us to determine our carrying amount, we are talking of our cost minus accumulated depreciation. And for us to determine our tax base, we are talking of cost minus our capital allowance. That will be very key for us to understand and have it at the back of our mind, which we'll find that it will ease in our work to understand this concept very clearly. Now, the next question will be, what are the types of temporary differences that we normally tend to talk about? So that should take us to types of temporary differences. Types of temporary differences. Types of temporary differences. Types of temporary differences. For types of temporary differences, basically, my good student, you should understand that we normally tend to talk of two main types. These will include the following. These will include the aspect known as taxable temporary differences. So talk about aspect number one, taxable temporary differences. Taxable temporary differences being our number one. And number two, we will be talking of deductible. We'll be talking of deductible temporary differences. Deductible temporary differences. Deductible temporary differences. These are the two types of temporary differences that we will be talking about. So by doing so, let us start by understanding the first one. That is, of course, the taxable temporary differences. Anytime you are to talk of the taxable temporary difference, you'll find that it arises when the carrying amount, this is a TTD, taxable temporary differences. It arises when the carrying amount, remember we've talked of the carrying amount, it arises when the carrying amount is more than the tax base, is more than the tax base, is more than the tax base, is more than the tax base. It arises when the carrying amount is more than the tax base. That is when we'll be having a taxable temporary difference. In this case, you'll find that in this case, it will give rise to deferred tax liability. And by the way, taxable temporary difference is also known as what? Is also known as positive temporary differences. It's also known as a positive temporary, and you'll find the reason why you are saying it as a positive temporary differences. You'll see why you'll be terming it as the positive temporary differences. So you're saying that this is where our carrying amount is more than the tax base. That is when we'll be having our taxable temporary difference. Then number two, in this case, key element that again we should understand here is that the taxable temporary difference will give rise to an obligation in future, where we are talking of it will give rise to deferred tax liability. It will give rise to deferred tax liability. It will give rise to deferred tax liability, meaning that it will give rise to an obligation in future. It will give rise to an obligation in future. It will give rise to an obligation in future. So that is one element that we should be able to understand when it comes to TTD, taxable temporary difference. What about the second one? DTD, deductible temporary difference. You'll find that this is the opposite with what? TTD. This is the opposite to taxable temporary difference, because at this point you are saying the carrying amount here, the carrying amount is less than the tax base, is less than the tax base. The carrying amount is less than the tax base. And if it is less than the tax base, at this point you are going to term it as negative temporary difference. Negative temporary difference. The carrying amount is less than the tax base, and therefore we are terming it as what? As a negative temporary difference. And again, the key concept that we should understand is that for deductible temporary difference, this will give rise to an economic benefit in future, meaning that it will give rise to deferred tax asset in future. It will give rise to deferred tax asset. So the moment you are able to understand these few concepts and very key and important concepts, you'll find that handling any question for deferred tax, it will always be very easy and very swift for us. It will always be very easy and very swift for us. So my good students, in the next class, I want us to meet and handle a full question of deferred tax. I want us to meet in our next class and handle a full question for deferred tax. So to that point, thank you so much, and let us meet in the next session. Thank you.